Now here's an example of an explosive price spike. So this is then the other type of trade setup is the iron condor, not to be confused with the iron condor credit spread. So this is one that is a really good one if you think there's a chance that the specific stock after the earnings will explode either up or down, but you don't know. This is a way to play it non-directionally. So it's going to give you a defined risk trade, and so debit paid will be your risk, non-directional, and so it takes advantage of the earnings release price spikes either up or down. We don't care, we just want the big move. So set up for explosive moves. Again, short duration, 1 day to 3 days is the most on these types of trades. These are all specific non-directional earnings release type trades. All right, so that's one. And here's going back, here's AKAM. This is one that we did on it based on these statistics that I showed you earlier. So you can see here, just looking at the worksheet, that AKAM has that profile of history of big moves. Here it was down over 14%, up 10, down almost 11, down 8. That was a small one. Going back over, I can go back over more cycles than that, but just 9 cycles to illustrate it was big moves of 10.5%. So some moves were bigger than that. So you can see these were just, back November 2024, August. These are the cycles, the earnings cycles, okay? And so looking at that, that tells me, okay, well, if I'm going to do something on this, I'm not going to sell volatility in time, because this thing could just rip right through your short strike, and you're going to be totally, at risk of your whole, credit paid or debit paid, for example, here. So what you don't want on this is what you're doing here on a trade like JP Morgan, because your potential risk on this one, if it went through your short strikes, you could lose $205. On AKAM, if you did that, you would be losing something like that or even more. All right, so there's specific things that you do. And so this one was doing the iron condor debit spread. So set this one up as that trade. And so you can see the expected move going into this one was for a move of over 9, close to 9.5% up or down. And the next day, though, this thing closed down down 14%. Actually, I think it closed down more, but the trade setup was for 6% up or down. So you can see here the trade was set up right here going in, where it was trading at 98.15 right in here, okay? And so this was either we were looking for a big spike up, spike down, didn't care, just needed a big move, and this thing just totally, collapsed to the downside. So this is how the trade was set up to take advantage of that probability of that based on the stats. So we did this with the iron condor debit spread. So went out and bought, you can see the 202, 204 call, sold, and then bought the 204, 94, 92 put debit spread. So the trade looks like this on a risk profile basis. Okay, I'll show you that next. So you've got a call debit spread, a put debit spread, and this is set up for either a big, huge spike up or a big spike down. So the potential spread cost, the max risk on this one was 145 bucks. The profit then, if it exploded up or down or up here, was for a profit of 55 bucks on that risk. So a potential for a 38% return. But again, this is a probability trade based on the past performance. Okay, so this one then worked out great. And so this one you can see closed down, was down here, right here, after the earnings release. So this one just got it just crushed to the downside. So it was trading here at 76.83 as it was going out. So it's max profit. So the debit cost was 145. This went out at a spread cost of $2. So that was your profit of 55 bucks or 38% return on that trade.